Hello, traders, and welcome back to VT Markets Traders Brew, where we will discuss market movements, trends, and perspectives to help you better navigate the financial markets. Today, we have a special guest with us, an experienced analyst of over 11 years in the CFDs market. It is my pleasure to introduce Beam, our market analyst from VT Markets Thailand. Beam, welcome to the show. How are things?
Hello, everyone. My name is Beam. Nice to meet you guys.
Perfect. Yeah, so today's topic is on central banks and policy changes. And honestly, for me, it's sort of a big package to unravel, right?
Mm-hmm.
I only recently took my first steps into the market, and it's really not something I think, lay people like me, together with our listeners, can, I guess, understand intuitively. It's just a big mess, and you don't really know where to start. Right. So, I mean, Beam, you've probably been having 11 years in the markets. Can you tell me a little bit about central banks? What are their primary functions, and what are some examples you can think of?
Okay, let's introduce about the central bank. A central bank, reserve bank, national bank, or monetary authority, is an institution that manages the currency and monetary policy of the country or monetary union. In contrast to a commercial bank, a central bank possesses a monopoly on increasing the monetary base. Many central banks also have supervisory or regulatory power to ensure the stable of the commercial bank in their jurisdiction to
Mm.
prevent bank run and in some case also to enforce policy on financial consumer protection and against bank fraud, money laundering or terrorism financing.
Ah, I see. So it's like I guess you'd say it's like something like a safeguard because you tell me it's different from commercial banks, right? So I take that, central banks are like I guess like the big brother of banks. Are they related? How do they sort of like interplay that sort of connection?
A central bank is the most developed nations are usually set up by to be, institutionally and independent from political interference. Even though governments typically have governance right over them, legislative bodies exercise scrutiny, and central bank frequently do show responsiveness to policy.
Ah, okay. They are more. So central banks are not just banks themselves. They also have some sort of control over the policy framework that
Like that.
that is governing the monetary policy that's sort of governing the nation, right?
Mhm.
But I never really understood, like, I think the sort of the idea of central banks have sort of evolved over time, right? It's never been like sort of a static concept. Now we see it, carrying, handling the monetary policy, but things may have been quite different in the past. So can you tell
Mhm.
me a little bit about how central banks have evolved over the years, and have their roles sort of changed in these years?
Okay, let's talk about the history of central bank. From the beginning, the story of central bank goes back at least to the 17th century,
Wow.
to be founding of the first institution recognized as a central bank, the Swedish Riksbank, established in 1668 as a joint stock bank. It was chartered to lend to the government fund and to act as a clearing house for commerce. A few decades later,
Hmm.
around 1694, the most famous trade bank of the era, the Bank of England, was founded also as a joint stock company to purchase government debt.
Hmm.
Other central banks were set up later in Europe for similar purposes. Though some of the established to deal with monetary disarray. For example, the Bank de France was established by Napoleon in 18th century to stabilize the currency after how to say hyperinflation of the
Okay.
paper money during the French Revolution, as well as to aid government finance. Only central bank issue private notes which serve as currency, and they often had a monopoly over such note issue. Why these early central bank helped fund the government debt? They were also private entity. They engaged in banking activities because they held deposit and of the other bank, and they came to serve as bank for bankers, facilitating transaction between banks or providing other banking service. They become the responsibility for the most bank in the banking system because of their large reserve and extensive network of correspondent banks. And these factors allow them to become and to lender of last resort in the force of a financial crisis. In other words, they becoming willing to provide emergency cash to their correspondents in times of financial distress. Okay.
Cool. Cool. So you're telling me that Napoleon, the Napoleon, right, has something to do with monetary policy, and that is a relatively recent invention. Well, it's that's interesting. I do want to ask though, like we talk about this all the time, and I see it all over the news, right?
Mhm.
People talking about monetary policy. What exactly is monetary policy? Like where does one line start and one line begin? You get what I'm saying? Like where is it like just like basic fiscal prudence, and where does monetary policy begin? And how do central banks use like monetary policy to influence the economy?
Okay. First of all, you have to know what is monetary policy. Monetary policy is the policy adopted by monetary authority of nation to affect monetary and other financial conditions to accomplish broader objectives like high employment and price stability. Further purpose of the monetary policy may be contribute to economic stability or to maintain predictable exchange rate with the currency. You know,
Mm,
Today, most central bank in developed countries conduct their monetary policy within an inflation targeting framework, where monetary policy where the monetary policies of most developing countries, central bank target some kinds of a fixed exchange rate system.
mm,
A third monetary policy strategy and targeting the money supply was widely followed during the 1980s, but has diminished in popularity since that. Thought it is still official strategy in a number of emerging economies. For the tool of monetary policy vary from central bank to central bank, depending on the country state of the development and institutional structure, tradition, and political system. Interest rate targeting is generally the primary tool being obtained either directly via administratively exchanging the central bank's own interest rate or indirectly via a open market operation. Interest rate affect general economic activity and consequently employment and inflation via number of different channels. Known collectively as the monetary transmission mechanism and are also an important and determinant of exchange rate. So, other policy tools include communication strategy like forward guidance, and in some
mm-hmm,
countries,
mm-hmm.
setting of a reserve requirement. Monetary policy is often referred to as being either expansionary and constitutively or contractionary. Okay, hence decreasing like that.
Okay. So you're telling me right now that actually there is no like sort of like one size fits all policy for the whole world, right? Because I was under the impression like, no matter what policy you sort of like listen to the Federal Reserve, that was my impression. But you're
Yes.
telling me right now that because of the different ways that countries manage their money based on their different sort of agendas, the results become very, very different. Is that what you're saying?
Mhm.
I see.
Uh,
Okay, right. Okay, but one common theme, right? As I have read up online, the one common theme is that a lot of these central banks set some form of what you
mhm.
call interest rates, right? So what do you think these rates have, and what's the impact that you think that these rates have on economic growth and inflation?
Okay, I'll explain how interest rate affect everyone first. Okay,
Yeah, sure.
changes in the interest rate can have both positive and negative effect to on the market. A central bank often change the target interest rate is respond to economy activity, raising rate when the economy is over strong and lowering rates when the economy is sluggish. For example, in the USA, Federal Reserve is responsible for setting the target interest rate at which banks borrow and lend money to the other, and this had a ripple effect across the entire economy. Why? It usually takes at least 12 months of for change in this interest rate to have a
Mm,
widespread economy impact. The stock market response to the change of is often more immediate.
mm,
In addition to federal fund rate and Federal Reserve also set discount rate or the interest rate that the Fed itself charge banks that borrow from it directly. This rate tend to be higher than the target federal rate. And for the last thing, to understanding the relationship between interest rate and stock market can help investors to understand how change may impact their investment. So they can also be prepared to make a better financial decision like that.
okay, I see, I see. So it's really sort of like watch how the market reacts and then slowly adjust your policy so that it fits A, the agenda, and B,
Mhm.
the kind of inflation or the kind of uh, uh contraction that you want to see in the economy. Is that correct?
Mhm. Yeah. Right.
I see. I see. Interesting. Right. And you hear this phrase being thrown around everywhere whenever you look up, just Google monetary policy, right? This thing called quantitative easing. Now, it's my understanding that not every bank does this. Not every central bank does this. So
Mhm.
there are most banks do this, right? So what exactly is quantitative easing, and how do central banks use it to stimulate the economy?
This is very important part that beginner trader doesn't know. Okay, let's talk about what is quantitative easing or QE. The QE is a form of monetary policy in which a central bank, like the United States Federal Reserve, purchases security in the open market to reduce interest rate and increase the money supply. QE creates a new bank's reserve, providing bank with more liquidity and encouraging lending and investment. In the U.S., the Fed implement a QE policies. Okay, to understanding QE. The QE is often implemented when the interest rate hover near zero and economic growth is stalled.
Okay.
Central bank have limited tools like interest rate reduction or to influence economic growth. Without the ability to the lower rate further, central bank must strategically increase the supply of money.
Mm,
Well, to execute QE, the central bank buy government bond and the other security, injecting banks' reserve into the economy. Increasing the supply of money provide liquidity to the banking system and lower interest rates further. This allow banks to lend with the easier terms. So the government fiscal policy may be implemented concurrently to expand the money supply. While the Federal Reserve can influence the supply of money in the economy, the U.S. Treasury Department can create new money and implement new tax policy with fiscal policy. This send money directly or indirectly into the economy. So,
mhm.
QE can involve a combination of bank monetary and fiscal policy. Okay, let's talk about Does the QE work? Most economists believe the Federal Reserve quantitative easing program, or QE, helped to rescue the U.S. and the global economy
Mhm.
following the like around 2007 or 2008 financial crisis. However, the result of the QE are difficult to quantify. Globally, central banks have attempted to deploy quantitative easing as the mean of preventing recession or deflation in their country, with similarly inconclusive result. While QE policy is effective at lowering interest rate and boosting the stock market,
Mhm.
its broader impact on the economy is apparent. Commonly, the effective of the QE benefit borrowers over saver and investor over non-investor. Commonly, the effect of a QE is benefit borrowers over saver or investor over non-investor. Okay, like that.
Ah, okay. So you're saying, I mean, I could get the gist of it, right? It's a pretty pretty tricky concept, like like you were explaining. Uh,
Yeah.
so it's some kind of managed inflation in a sense, because it is, they do generate more money supply, right? A little bit more,
Mhm.
is in a controlled way. So in a sense, the goal is to sort of stimulate the economy, right? By keeping the prices, the money, the price of money lower, so investors can come in, and they will likely reap the benefits of being able to come in at a lower price, right?
Mhm.
I see. So it is a form of, I guess, targeted inflation. Would you say that? Right. So are there like these sort of targets that central banks have to attain, like in to maintain this sort of stability? Because obviously, many banks, central banks, are taking a lead from the Federal Reserve, right? They are doing their own form of quantitative easing. So
Mhm.
when it comes to targeting a certain sort of uh outcome in an inflation, right? Are there targets that central banks have to maintain this sort of economic stability?
Uh-huh. Okay, we usually hear about a target rate in economic news in every day, right? What is inflation targeting? Inflation targeting is a central bank policy that revolves around adjusting monetary policy to achieve a specified annual rate of inflation. Um, you know, this is known as a target rate, which normally set around 2% or 3%. Okay, the principle of inflation targeting is based on the belief that the long-term economic growth is best achieved by maintaining price stability, and price stability is achieved by controlling inflation. So, inflation targeting can be compared with the other central bank operating targets, such as price level targeting, or nominal gross domestic product, or GDP targeting. To understanding inflation targeting as a strategy, inflation targeting view the primary goal of the central bank as maintaining price stability of the tools of monetary policy that central bank has, including open market operation, or OMO, and discount lending can be employed in the general strategy of inflation targeting. Inflation targeting can be contrast to the strategy of the central bank aim at other measure of economic performance as their primary goal, such as targeting currency exchange rates, the unemployment rate, or the rate of nominal GDP growth. Okay, interest rate can be an intermediate target that central bank use inflation targeting. The central bank will lower or raise interest rate based on whether it thinks inflation is below or above the target threshold. Raising target rate is said to slow inflation and therefore slow economic growth. But lowering interest rate is believed to boost inflation and speed up economic of growth. And moreover, the benchmark used for the inflation targeting is typically a price index of the basket of consumer goods, such as a consumer price index or CPI data, or the personal consumption expenditures or the PCE data, which is now used by US Federal Reserve.
I see. So, uh, how then, now that we know that, they have some sort of control, or at least some sort of response mechanism, right, against sudden events, sudden, I guess we call them news events, right? Now that we know that the central banks have this sort of control, how have they responded so far? We have had quite a few what we would call financial crises over the last, 30, 40 years, right? So how has, using some prominent examples, how has central banks responded to such financial crises to sort of like stabilize the economy?
Okay, for the example, the 2008 global financial crisis, which caused the severe impact on the economy, is a crucial lesson for the central bank and investors across the globe, raising awareness of the needs of the financial system, risk monitoring, and the new approaches for handling risk. So many countries thus establishes a framework of monitoring financial stability that is suitable for each country context. Including the setting up of a various committee, such as for the exchange information between financial regulators, formulating policy to ensure financial stability, and
Hmm.
ordering action in accordance with laws. So the reason for the establish for a new financial stability monitoring framework, first, the central bank has insufficient power or tools in ensuring financial stability. Second, lack of cooperation between financial regulators lead to unregulated area in some countries. This
Hmm.
create opportunity for profit making and increase the risk of a price bubble has
Mm.
leading, hence leading to financial crisis. And the third, the conventional supervisory framework is unable to oversee new financial products, and that are increasingly introduced, preventing a comprehensive risk monitoring.
So there are a lot of steps they sort of undertake to sort of respond to these financial crises, right? And is it because of this that central banks, you know, often adopt their own kind of policy, right?
Mhm.
Why is it important for central banks to be in this sense sort of independent from other political influences from around the globe?
Okay, central bank independence refers to the degrees of autonomy and freedom of a central bank has. The conducting is its monetary policy and managing the financial system. You know, uh, it is a key aspect for the modern central bank and has the roots of recognition that monetary policy decision should be based on best interest of the economy as a whole, rather than being influenced by short-term political consideration. So the concept of the central bank independence emerged in the late 20th century, as
Hmm.
many countries were struggling with high inflation and grow recognition that monetary policy need to be independent from political influence. And the idea was that central banks should be the free to make a monetary policy decision that were in the best interest of the economy, rather than
Hmm.
being swayed by the short-term monetary consideration, like I said before.
I see, I see. So it's like in a sense they should, I mean, ideally, right? Ideally speaking, of course we know that
Yeah.
there are central banks that have other sort of agendas, right? So ideally the intention is to, push monetary policy so that the country can sort of move forward in accordance with the, I guess, the public good. Is that what you mean?
Mm-hmm.
I
Yes.
see. Okay. Yeah. So I'd like to talk a little bit because I know a few central banks, right? Obviously, I can't recite them all, but there are a few big names in the business, right? We
Mm-hmm.
know about the Federal Reserve, we know about the European Central Bank, the Bank of Japan, with the recent propping up of the of the yen, right? So we hear about them in the news, right? So maybe you can tell us a little bit about, the differences between, I mean, aside from the currency that they're handling. I mean, obviously they're handling, like, one is handling the USD, one is handling the euro, one is handling the yen, right? So aside from those differences, from the currency that they're handling, like, what are the, main key differences in terms of, like, attitude, or maybe their approach to it towards handling monetary policy?
Okay, before we know the major central bank, let's move back to the first question. What is central bank? I believe every nation or region has a central body that is responsible to oversee its economic and monetary policy, and to be ensure that financial system remains stable. As you know, this body is called the central bank. Unlike a commercial and investment banks, these institutions aren't market based, and they are not competitive. So for the major central bank, like you said, like USA Federal Reserve System of the Fed. Um, the Federal Reserve is commonly referred to as the Fed. Is the central bank of the United States. It is probably the most influential central bank in the world, with the US dollar used for approximately 90% of the world's currency transaction. So the Fed sway has a sweeping effect on the valuation of many countries. Okay, that's for the Fed. So let's talk about the Eurozone. We today we have a European Central Bank, or ECB. The ECB was established in the 1999. The governing council of the ECB decided on change to the monetary policy. You know, the council consists the six members of the executive board of the ECB, plus the governor of the national central bank from 19 eurozone countries. Okay, talk about ECB. Let's talk about BOE.
Okay.
The Bank of England. Bank of England, or
Mm-hmm.
BOE, is publicly owned, which means it report to British people through its parliament. BOE is founded in 1694. It is often touted as one of the world's most effective central banks.
Mm-hmm.
Okay, that's it for a Eurozone. Let's move into the Asian. Bank of Japan, a famous BOJ, began
Yeah.
operating in 1882. Okay, so the mission is to maintain to price stability and ensure the stability of the financial system. This makes inflation the central bank's top focus. Yeah, so as Japan is very dependent on export, the BOJ has an even more active interest than the ECB does in preventing an excessively strong currency. So the Bank Monetary Policy Committee consists the governor, two deputy governor, and six other member. And the central bank has been known to enter open market to artificially weaken its currency by selling against US dollar and euro. The BOJ is also extremely vocal when it concerned about excess currency volatility and strength. So it meets 8 times a year.
Well, 8 times a year. Wow, that's a lot of meetings.
It's, yeah, that's a lot.
Yeah.
Okay.
Okay.
Um. Uh. The other major central bank is the BOC, not Bank of China. Many beginner trader is misunderstand. They understand BOC is the Bank of China. No, BOC is stand for Bank of Canada, right?
Oh, right. Bank of Canada. All right. Okay.
Okay, the BOC is mandate is the ensure stability in Canada's economy and financial system. It accomplished this by enacting monetary policy, overseeing the financial system, and maintaining the value of supply and of the Canada's currency, and managing public debt. Okay, the BOC has had an inflation target of 1% to 3%, with the aim of keeping it near 2%. It has done a good job of keeping inflation within the range since 1998. So, monetary policy decision within BOC are made by consensus vote and you know in the governing council, which consists the bank governor, the senior deputy governor, the four deputy governor, the executive council, which is made up for the governing council and the chief operating officer, draft the bank strategy direction. Okay, this is all of the major central bank in the world.
I see. Actually, I'm quite curious, right? And this is more like a trivia, I guess, a trivia question, right? Like,
Mhm.
obviously, Japan is one of the big players in the list, and we have seen, I guess in a way I can understand why Japan is such a big player. It has a pretty established sort of industry. People will be looking out for the Bank of Japan. But
Mhm.
why are other big industries that are within the Asia region not on this list? Like you just mentioned, the PBOC, the People's Bank of China, and also I'm not sure about the name, the Korean Central Bank. There's a lot of interest in Korea nowadays, right? So
Yeah,
you
I
would
know.
imagine that their industrial economy should be as big, or if not bigger than say Japan, right? So why are their central banks not considered major central banks? And just like they exist, right? We obviously know that they do make policy changes as well. But
Mhm.
why do you think? And this is really just a opinion sort of question, right? Why do you think these banks don't really see the spotlight these days?
Okay, let's talk about how national interest rate affect currency value and exchange rate. So, a country often issues a monetary policy impacting a national interest rate and achieve specific economic goals. Whether the country is attempting to promote job creation or stem inflation. So, the country is intentionally manipulating the monetary supply, availability of credit, and the cost to borrow more money. So, as a result, monetary policy changed that impact national interest rate, change the value of the country's currency. So, residual impact of raising or decreasing interest rate is the country's currency value will become stronger or weaker.
Okay, so yeah, okay, I understand that, right? I can understand that, there are so many different sort of central banks, and obviously, like you said, right, they all approach the thing, monetary policy very differently, right?
Mhm.
I do want to talk a little bit more about, central bank policies. How do they affect? I mean, obviously, it's some sort of competition, right? Every central bank is offering their currency out into the market in different ways, right?
Mhm.
Maybe you can tell me a little bit about, obviously in Forex, we can see that the prices fluctuate, let's use the Ninja for example. It's the Japanese yen against the US dollar, right?
Mhm.
So when the US dollar strengthens, Japanese yen indirectly, right, falls, right? Because
Yeah.
the exchange rate is sort of imbalanced that way, right?
Mhm.
So, uh, how can central banks affect this sort of currency values and exchange rates? Can you tell me a little bit more about it?
Okay, how interest rate affect the currency, right? A country often issue monetary policy impacting the national interest rate to achieve specific economic goals. Whether the country is attempting to promote job creation or stem inflation, so the country is intentionally manipulating the monetary supply, availability of credit, and the cost to borrow money. So, as a result, monetary policy change that impact national interest rate change the value of the country's currency. And radical impact of raising or decreasing interest rate is that country's currency's value will become stronger or weaker. So, and downstream impact on global exchange rate occur. Let's talk about the factor impacting interest rate. Um, so A country monetary policy and action toward interest rate are often driven by the several microeconomic factors. You know, in addition, public sentiment toward the country, its government and its economy standing play an important part as well. Okay, and for a politic factor, the politic factor that recent history of the U.S. Clearly illustrate the critical importance of the country's overall perceived political and economic stability, and in relation to the currency valuation, as the U.S. government and the consumer debt rise, interest rate and maintain near a zero in an attempt to stimulate in the U.S. economy. When the economy recovered and grows, interest rate increase in an attempt to slow inflation. Okay, that's the politic part. For the economic part, even with historically low interest rate, the US dollar will still enjoy favorable exchange rates compared to the countries of the most the other nation. This is partially because the U.S. remain at least some extent in the position of being reserve currency for much of the world. So this is most often measured through the country GDPs. And as the GDP growth and currency value, often move together. The GDP is often used by national central bank when deciding future impact on interest rate. So for the global trade factor, these factors such as a country's balance of trade between import and export can be crucial factor in determining currency value as well. So this is because greater demand for the country's product means greater demand for the country's currency as well. The analysts often cite the country balance and of trade and net trading position as the signal of the currency strength. Okay, like that.
I see. Okay. Right. So because of that, right? I think all of them are in a sense affected, like you said, right, by the Federal Reserve because like they are the big brother, right, of the central banks, right, and a lot of them base their policies based on the Federal Reserve because it's sort of like the global reserve currency for them, right? And it makes sense. A lot of countries may have their own local currency, but they still transact in USD. Am I right?
Mm-hmm.
So I want to know, since it's the big boy of the whole monetary policy scene, right? Can you tell me a bit more about the structure and functions of the U.S. Federal Reserve?
Okay, you're talking about federal system, right? The Federal Reserve System is the central bank system of the United States. It was created on December 23 in 1913. Okay, with the enactment of a Federal Reserve Act. So after series of financial panics, particularly on panic of the 1907, led to a design of the central control of the monetary system in order alleviate financial crisis. Um, over the years, events such as the Great Depression in the 1930s and the Great Recession during around 2000s have led to the expansion of the roles and responsibility of the Federal Reserve System.
Hmm. Okay, I see. So and I've the Federal Reserve is pretty consistent throughout, right? And I know everybody is
Mhm.
the whole world sort of moves whenever they come out and say that they have decided to raise or reduce interest rates, right? Uh,
Mm.
And interest rates, I just want to visit interest rates again. I recently read up on a very interesting topic. You were telling me that a lot of economies actually use interest rates to sort of control, right? To either contract or to sort of like loosen up the economy, right? Uh, I want to know a little bit more about this interesting keyword I saw. Negative interest rates, right? What are negative interest rates? And it's sort of like logically it just doesn't make sense, right?
Mhm.
Yeah, what are negative interest rates and why do some central banks sort of implement them into their monetary policy?
Okay, the last country that negative interest rates exist is Japan. Since the last year until the
Land of the rising
BOJ
sun.
decided to increase. So let's talk about what is negative interest rate. Um, the term the negative interest rate refers to a situation in which interest is paid to the borrower rather than to lenders. When interest rates are negative, a central bank typically charge commercial bank on their reserve as a form of a non-traditional expansionary monetary policy rather than crediting them. So
Mm,
this is very unusual scenario that generally occur during a deep economic recession when monetary effort and market force have already pushed interest into their nominal zero bound. So this tune is meant to encourage lending, spending, and investing rather than holding cash, which will lose value to negative deposit rate. So for the example of the negative interest rate, um, central bank in Europe, and Scandinavia, and Japan have implemented a negative interest rate policy on excess bank reserve in the financial system and unorthodox monetary policy tune is designed to spur economic growth and through spending and investment. Depositor will be incentivized to spend cash rather than store at its bank and incur guarantee loss. So how can interest rate turn negative, right? Interest rate tell you valuable money is today compared to the same amount of money in the future. Positive interest rate imply that there is a time value money where money today is worth more than money tomorrow, and forces like inflation, economic growth, and investing, spending, all contribute to this outlook. And a negative interest rate, by contrast, imply that your money will be worth more, not less, in the future.
mm,
So, what do negative interest rate mean for the people? Most instance of the negative interest rates only apply to the bank reserve held by a central bank. However, we can ponder the consequence of more widespread negative rate. So first, the saver would have to pay interest rate of receiving by the same token, borrower would be paid to do so instead of paying their lender. So therefore, it would incentivize many to borrow more and larger sums of money and forego saving in favor of consumption or investment. If they did save, they would save the cash in the safe and or under methods. Or the under mattress. Rather than pay interest into the bank or for depositing it.
I wanted to confirm. You just said keep money under the mattress.
Mhm.
So you're saying that negative interest rates will make people want to, keep money inside underneath the mattress rather than deposit them in banks. Is that what you're saying? Interesting. Okay. I one more topic, and we are running a little bit short on time, right? I do want to touch briefly on this thing that has been in the craze in the blockchain world, right? Central bank digital currencies, also known as CBDCs, right? I hear it everywhere. That they say it's the future of money and the role, and you know. I just am curious about the role of central banks in managing these digital currencies. I mean, obviously, right now we already have like different sort of stable coins. We have USDC, you have USDT. There's also
Mhm.
the DAI, decentralized DAI stable coin, right? So there are a bunch of stable coins already out there. So can you tell me about how central banks will play a role in issuing these CBDCs, and maybe a little bit about how you think CBDCs might be different from these stable coins?
Okay, good question. CBDC. Okay, I will according to Bank of Thailand. Okay, CBDC is a digital currency issued by a country's central bank. In Thailand, CBDC is comparable to the fiat money issued by the Bank of Thailand, which can serve as a medium of the exchange, store of value, and unit of accounts, but in a digital form. So, what are benefits of CBDC and why should be studied and developed? According to the survey of the conduct by bank for the international settlement in 2021, central bank interest in retail CBDC has grown over recent year. While a central bank in emerging market economy are more interested in exploring the potential use retail CBDC to replace or reduce cash usage. Increase the efficiency and safety to a domestic payment system and promote the access to digital finance services. Central bank in advanced economy are interested in using retail CBDC as an alternative payment to enhance the safety, resiliency, and availability of the payment system. Yeah, that's a new trend for today.
I see. Wow. Okay. Yeah. I mean, I really didn't know that they were already so far ahead. Actually, I read somewhere that China is really, already rolling out their own CBDC, the ECNY or something or whatever it's called, right? And so far it's been a large success. I think, we
Yeah.
can expect a lot of new things with CBDCs. I do believe that we definitely will see some practical applications of it on the blockchain. It's probably like 24/7. So that's interesting. Uh, okay, moving back to what we were initially talking about, right? Obviously, and central banks obviously have a line of communication to the media, right?
Mhm.
And they I think they do test out some kind of ideas, right? Like, how will they? And I read somewhere, recently, that the ECB is hinting at some sort of a rate hike. So it
Mhm.
seems like this hinting thing is happening even without the central banks telling you things, right? So how do central banks communicate like their intentions? Maybe they're not really enforcing it right now, but how do they
Mhm.
communicate their future policy intentions to sort of influence the economic expectations of a particular,
Mhm.
region?
Okay, the first, let's talk about the forward guidance. Forward guidance is a tool used by a central bank to exercise its power in a monetary policy in order to influence with their own forecast, market expectation of the future levels of the interest rate. Communication about the likely future cost of a monetary policy is known as a forward guidance. Individuals and businesses will be use this information in making decision about spending and investment. Thus, forward guidance about the future policy can influence financial and economic conditions today. The strategy can be implemented and in an explicit way, expressed through the communication of the forecast and future intention. Sometimes known as the audition, imply forward guidance also exists. Sometimes referred to as Delphic forward guidance. It is a softer and less binding version of forward guidance to achieve similar effect. Among the remain central bank, Delphic forward guidance dominate, although they a couple of exceptions, such as U.S. Federal Reserve, which makes a quite specific but still conditional statement, and the Bank of Japan.
Okay, Beam. Yeah, okay, that all sounds very, very interesting. I just want okay, we're really running short on time, so let me just we will just jump ahead to the final question I have for you, right? So considering now that we know all of these things about the central banks and their policies, right?
Mhm,
What
mhm.
do you think traders should look out for, and what are some key indicators that usually indicate that they should reconsider their trading strategy, especially in the face of changing fiscal policy from central banks?
Okay. What should trader look out for? You should look for a VT market analyst as much as possible. Only joking.
Yeah, yeah, of course, definitely. Yeah.
Okay. The things to look before you place a trade. Because when you're trading the market, there are many things to look out, like support and resistance, trend lines, and multiple time frames analysis, indicator, or candlestick pattern, the chart pattern. All of these, you are overwhelmed and confused, and you don't know what to do, right?
Mhm.
Um, okay. The first of all, you have to know the market structure. The point of market structure is about asking yourself where's the path of least resistance in the market is in uptrend, and that what do you want to do? Okay. Do you want to buy it or not? And we're going to buying in an uptrend. Likewise, if the market is a downtrend, and what should you do? You should be selling in the downtrend or buying against a trend, right? Okay, the first is the market structure. The second, the area of value. Once you've identified the market structure, uh, where my potential buying or selling pressure is coming. Just because the market is an uptrend, it doesn't mean that you want to be buying immediately, because the market might be ready for reversal, and it might be about the make a pullback like that. You want to trade from an area of value, an area of where you can be defined to a numerous way. In it can be support and resistance, trend line, moving average, channel, blah blah blah. And there are many ways to define an area of value. I'm just going to walk you through a few ways, right, to define it. Okay. Um, the third thing you have to know is about entry trigger. This is what will get you into the trade. This is what will inform you it's time to buy. When you're looking for the entry trigger, and entry trigger could sum in a numerous form. Uh, it could be a simple price rejection, like a bullish engulfing pattern and shooting star, a hammer, or the break structure, and a lower time frame or a trend line break. Most people even use indicator like a crossing from oversold to the overbought as the entry trigger. That's fine as well. So, Devin, for the most important thing you have to know before you trade is you have to stick to your discipline. So, discipline can be taught in the seminar or found in the expensive trading software. So, traders spend thousands of dollars trying to compensate for their lack of self-control, but few realize that that a long look in the mirror accomplished in the same task at much lower price. And the important lesson is that once a trader has confidence in their trading plan, they must have discipline to stay the course, even when there are inevitable losing strength, like the overtrade is really dangerous. You should be avoided.
Okay, okay. Thank you, Beam. Wow, that was insightful. Right. So at the end of the day, you are the final piece of the puzzle, right? You are the one that sets the tone for how you're gonna trade, and you have to always consider, what is your goal before trading. I think that by itself is really insightful. And you're right. I don't think there is any sort of machine or
Mhm.
expensive trading software or even people themselves, right, that can sort of replace your own role in deciding the kind of trading outcome that you want. And I
Mhm.
do believe that you setting the pace is the way to go. Wow. Thank you so much, Beam. I really appreciate you jumping on this podcast with me. I think I've learned a lot from you. I'll be happy to invite you to come here and share with us a little bit more next time. Maybe I have another topic in mind, but thank you for guiding me, especially, seeing that I'm new to this whole trading journey. Yeah, and that really brings us to the end of our Traders Brew podcast. Thank you so much, fans, for listening to us again in this episode. And next time we're gonna have somebody new to share a little bit more about different views on the economy and as well as the perspectives on the financial landscape. Till then, I'll see you in the next episode. Join us for the next episode of the VT Markets Traders Brew podcast, where we'll continue to explore the fascinating world of the financial markets. Whether you're a seasoned trader or just starting out, there's always something new to learn. Our podcast is available on Spotify, Apple Podcasts, Amazon Music, and iHeart. Be sure to subscribe to us on those platforms for new episodes of our Traders Brew podcast. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. Trading leveraged products such as Forex and CFDs carries a high level of risk and may not be suitable for all investors. There is a possibility of losing all your initial capital. Before trading, you should fully understand the true extent of your exposure to the risk of loss and your level of experience. Please note that past performance does not constitute a reliable indicator of future results. Future forecasts do not constitute a reliable indicator of future performance. If you do not fully understand the risks involved before deciding to trade, you should fully consider your investment objectives, level of experience, and risk tolerance. You should become aware of all the related risks and seek independent advice from a suitably licensed financial advisor.